Hey everyone, welcome to Retire with Style. I'm Alex and I'm here with my trusted companion Wade, and today we're going to continue our Q&A from Wade's webinar on managing sequence risk, and today's focus will be on
Buffer assets.
buffer assets. But before we get into that, let's buffer this episode with folks who haven't been hearing from you. In the summer, at the start of the summer, what happened? Why was this? Why was there a Wade pause?
Well, we're in the throes of summer, but you're revealing we must have pre-recorded some of those episodes because there really wasn't a pause in that regard.
No,
But
I
yeah.
know, I know. I always working, hardest working man in the retirement biz, right here.
But yeah, I did have a trip to Japan. It was a good time. The exchange rate's still quite good, so you can enjoy nice restaurant meals for half the cost of in the U.S. It's a great time to be in Japan. I took
And why
the
Japan? Wade, this is like the third, fourth year you've gone in a row.
Yeah. Well, now I'm trying to study Japanese as well, and there's a series of 5 Japanese language exams taking with my kids. My oldest was at the highest, well, they're in reverse numbers. So N1, which is the top one. My daughter and I are at the second level, which is the N4. We both took that test in Japan, and then my youngest was taking the N5 test.
There you
So we
go.
were there to study Japanese and get ready for our tests also.
And many people won't know that you're married to a Japanese lady, and that's
Right.
where the trips come from.
Yeah, and I lived in Japan for 10 years.
That's
So
right. And you didn't even bother with them. All of a sudden, you have this newfound love for the Japanese language.
yes.
All
No,
right.
I've got a little more time now than I did when I always should have been studying more, but trying to learn all those characters and everything.
Yes, yes, that's you, Wade. Lifelong learner. Lifelong
That's
learner.
right.
All right. All right, let's get to these questions then here. Before we begin, though, in a similar way that you did in the last episode, you gave everyone a quick rundown on ways to mitigate sequence of returns risk. Do you want to talk about the types of buffer assets? The types of buffer assets that you usually refer to.
Yeah. So buffer assets was the fourth way to manage sequence risk. It's the idea you have something outside your portfolio that's not correlated with the portfolio. Which means just if markets are down, your buffer asset's not losing value, and then you can temporarily tap into that to meet expenses, giving your portfolio an opportunity to recover before you then resume spending from the portfolio. And I talk about 3 buffer assets: cash on the sidelines, which in theory, I don't know, to be a buffer asset, you're kind of carving it out of your portfolio. But if you just considered it as part of your portfolio, it means you could have used a lower withdrawal rate from your portfolio. Cash is a bit of an odd duck, but cash, uh, the growing line of credit on a variable rate home equity conversion mortgage or reverse mortgage, and then borrowing from the cash value of permanent life insurance, in particular whole life insurance. Cash value life insurance, whole life insurance isn't exposed to losses as well. And so those are the 3 potential resources to use as buffer assets. Now, all 3 of them can be expensive to use. You're borrowing, and well, especially with a reverse mortgage as well, you have to set it up. With life insurance, usually you don't see the charges, but there's going to be a big commission baked into the pricing and everything else. But in the simulations and testing I've done, showing how even after considering those expenses, the synergies created by how this helps protect your portfolio by not having to sell from it temporarily can get you into a better position so that you can pay for those expenses, including the interest on the loan growth and so forth, and still have more left at the end. And so buffer assets can be a really effective way to help manage that sequence of returns risk as well. And it can be a way to just allow you to use a higher initial distribution rate from the investments at the same time, because you have this backstop to provide that temporary spending resource as well.
So effectively, it's just an earmarked chunk of money that you have that you can go to in case of fire. That's where you break the glass.
Mm-hmm.
It's not commingled or anything like that. When I hear you talk about it, it's that kind of vibe that really, you know, settles it for me.
Yeah, and that makes complete sense. I think with the reverse mortgage and the life insurance, it's just with the cash pile. It's why are you treating that as being separated from your portfolio? So
Sure.
You could. It's more like a
That's more for discipline.
behavioral
It helps you,
bucketing.
the cookie jar discipline kind of thing. But all right. And so then we got a lot of questions with that because, Wade laid the groundwork. Like, these are the four that we feel are buffer assets. But there's
Right.
always folks of what about? What about this? What about that? And so I think it was helpful if folks can, parcel out the commonalities of what those buffer assets have, especially when we start throwing these out. All right. And so here we go. This is from Urshad. Wouldn't a HELOC also be a suitable buffer asset? You couldn't repay it when your portfolio recovers from a drawdown.
Yeah, this question, when I talk about reverse mortgages, this is probably one of the most common questions. Why not just use a HELOC, which is a home equity line of credit? Usually it's cheaper to set up a HELOC. And so I think that's the motivation for the question. But that's really where its advantages end. So HELOCs can be frozen or canceled. And if you're using a buffer asset, the idea is you want to spend from it when the markets are not doing well, because that's the whole idea. You want to protect your portfolio when it's not in good shape. And HELOCs can be frozen and canceled. And that's, we saw this during the pandemic. We really saw this back like with the financial crisis in 2008. One of the early groups of researchers that promoted the idea of using the reverse mortgage, it was Harold Avensky and John Salter. And they run a financial planning firm where they had HELOCs for their clients to use really as buffer assets. And then the financial crisis of 2008 happened. And that's exactly when they want to tap into those buffer assets. And they were frozen. They couldn't tap into them. So that led them down the path of looking for the alternative. And so home equity conversion mortgage, the HECM, the reverse mortgage, it can't be frozen or canceled. That's the number one major advantage over a HELOC. Other advantages of the HECM, it has a growing line of credit. So you initiate it, and then that line of credit grows over time, whereas a HECM would be fixed. I'm sorry, with a HELOC would be fixed. And then also with a HELOC, you can have a more of a fixed repayment schedule so that you have less flexibility. Whereas with the HECM, you can delay any repayments until you move out of the home. And so you've got more flexibility there. And then also when you're retired, it may, in some cases, be harder to qualify for a HELOC if you don't have income and so forth. So that's the main differences. And that's why I really think you can't consider a home equity line of credit or HELOC to be a buffer asset. It's just, you need that to be there when the markets are down. And it probably won't be there when the markets are down. It's there for the good times, but it's not going to be there for the bad times. The reason to have a buffer asset is to have it there for the bad times.
And I concur. We went through the same issues with a lot of our clients during those two eras where, clients who are dependent on HELOCs just for their just normal activities, normal quote unquote emergencies that they could tap into, they weren't able to, and they were called. And so that did, to Wade's point, they're there for the good times, but they're not there necessarily for the bad times, because the banks during the bad times don't want anything to do with it, unfortunately. What you saw. Next question. What about MYGAs as a buffer asset in parens liquidity?
Mm-hmm. Now, so the HELOC, I would say no way on the buffer asset. For the MYGA, under limited conditions, I could accept it as being a kind of 3.5 buffer asset. So, well, MYGAs, they're the multi-year guaranteed annuities. They're much like CDs. They pay a fixed rate for a given period of time, and then you can renew them. They work a lot like CDs, but they're in the annuity world. Now, any sort of deferred annuity like a MYGA does allow free surrenders or free withdrawals from the account. And if you go up to that limit, you don't have to worry about paying any sort of surrender charges. As soon as you get into the surrender charge discussion, like if I had a MYGA and I want to draw from it to meet expenses, I want to use it as a buffer asset. Well, if I have to pay surrender charges on those distributions, that's a loss. I may have a 10% surrender charge. So that's definitely falling outside the bounds of being a buffer asset. But if it has fairly liberal abilities to draw from it without surrender charges, you could potentially consider it a buffer asset. I think the only other potential downside as well is interest payments. And this may be less of an issue with a MYGA, but say you had a 6-year deferred fixed annuity that doesn't pay any interest until the end of the 6 years. 5.5 years into that period, you want to draw from it to use it as a buffer asset. You may sacrifice getting interest for the past 5.5 years. So that's another thing to be careful about. But if you're avoiding these kinds of problems I'm mentioning, I'd be okay considering a multi-year guaranteed free withdrawals from it as a buffer asset.
Okay. What about, I'll ask one, what about CD ladders? Same logic?
Yeah, same sort of logic, same sort of same sort of potential caveats. Just what are you having to give up if you draw from it before the maturity date? If it's minimal, or if it's just like, say, you might have to give up 3 months of interest or something, that might be acceptable, and you might be able to consider it. And it does allow you to draw from it. If it's completely locked up, then it can't be a buffer asset. But if you can draw from it with minimal cost, you could potentially consider it as a buffer asset.
I'm going to throw a question here. I know we have some already, but this is a quick one. And I say it because I woke up early this weekend and I was channel surfing and CNBC was on. And in the mornings, they do like gold, like buying the actual coins and stuff like that. And they were pitching it. I knew this was coming up. And they were the commercial or the infomercial, they were pitching in terms of, I can hold it. I feel good. It protects. They were almost saying like a buffer to the buffer. Like a buffer to the buffer asset. And so I was almost curious, what are your thoughts on, I mean, I know the answer, but I'd rather have everyone hear you say it. What are your thoughts in terms of gold serving as a buffer asset? Because it provides the ultimate protection.
So the buffer to the buffer. No, the whole point of the buffer asset is it can't be correlated with the portfolio. But again, that's just a fancy way of saying, if your portfolio is down, you don't have to worry about your buffer asset also being down. And gold prices are volatile, so you don't have that worry-free aspect of, I know gold's not going to decline in value when I need to use it to cover my expenses. You may have to sell at a loss with gold. It's volatile just like the portfolio. Anything that's volatile in the downward direction, exposed to losses, is not a buffer asset.
So who watches the watchman?
Yeah, and that's the why the MYGA, any deferred fixed annuity has principal protection. So you're not exposed to a loss in that regard. Your principal is protected. That's where if you can draw from it without cost, you could potentially treat it as a buffer asset. But no, gold does not have principal protection.
Again, they were sort of pitching it as like, this is what you need when times are tough, kind of thing. All right, so let's move on here. What about a growth-oriented fixed indexed annuity, parens, without guaranteed living withdrawal benefits rider as a buffer asset?
Yeah, and so both of the MYGA and then this question were both from Fred, and the answer is pretty much the same. There's the same caveats as with a MYGA. An FIA, instead of paying, well, you could choose an FIA that pays a fixed rate, or you could choose the FIA that is going to provide principal protection, but then it's linked to a market index. And based on the performance of that market index, you could receive a positive return. So if that index was down, your principal is protected. If that index is up, you'll share in some percentage of the index growth. And so you get a variable positive return instead of a fixed positive return. So in that regard, no difference. You could treat that as a buffer asset in the same manner as a MYGA, and it's really just the same caveats. Are there surrender charges? Are you having to wait till the end of the term before you get paid any interest, so that you potentially lose a lot of interest if you draw from it? Yeah.
There may be some folks that you mind giving quickly an FIA and what the benefits do to it, the riders?
Well, this is without riders. Yeah, you can with any.
Sorry, but I read it with. Sorry.
If you add a guaranteed lifetime withdrawal benefit, then you can use it for lifetime income, and it behaves more like an income annuity. If you're not adding a guaranteed lifetime withdrawal benefit, it's really the case where you're using it more for accumulation And then you might, when you're thinking about your fixed income bonds and so forth, are there potentially annuities? And they also provide tax deferrals, so considering that as well, but potentially annuities that might offer competitive yields with respect to other bond options you have available. And of course, bonds don't have principal protection. If interest rates go up, you sell at a loss. And we saw that clearly in 2022 when a lot of bond funds had double-digit losses. That's where a deferred fixed annuity, and so an FIA and a MYGA are both examples of that. They're not exposed to that interest rate risk in terms of their principal's protected. You don't have to worry about selling at a loss, other than all these caveats about, well, if there are surrender charges and things, then you would have to sell at a loss, and then it's not a buffer asset.
All right. So it's really the infrastructure wrapper is what dictates, if it's a true buffer asset or not. The vehicle itself, but the actual investment or the way it's structured, it is. But depending on which one you bought, how you bought it, that's what could.
Yeah, and with shorter terms, but again, let me emphasize that point. Like if I bought a 6-year fixed index annuity, and it's not going to pay me any interest until the end of the 6 years, and 5.5 years into that, and say the market's been up 100%, whatever index is attached to, well, then you probably don't need the buffer asset. But the point is, if I don't hold it till the end of the term, I may not get any interest. And that could be a very costly way to structure a buffer asset as well.
There you go. All right, so next question. Reverse mortgage. Oh, no, sorry. Would love to see your analysis if it included all the costs associated with a HECM. HECM strategies do not come from the free store. Mm-hmm. What does come from the free store, Wade, so I can start shopping there, by the way?
Well, there's no such thing as a free lunch.
And that's from Kenneth.
Yeah, that's Ken. So great question. And let me refer you to my book, The Reverse Mortgages.
Wade just shifted the camera angle of his.
Yeah, if you're watching on YouTube. No, in my Reverse Mortgages book, I do a number of case studies where I show a number of different strategies that use HECMs, but I include all the costs. Even I include retail costs. You might be able to negotiate on some of this. I include the full retail costs of setting up the reverse mortgage, and then also a healthy margin rate as part of the loan. So any benefits that I show are net of costs, and I don't skimp on the costs because the potential benefits are so strong. Again, you can cover those costs and still have net positive outcomes. So I don't skimp on the costs when I'm simulating different strategies with the HECM. So the analysis includes all closing costs. I think in the case study in the book, it's just setting up the reverse mortgage was running you close to $20,000. And the main closing cost is the 2% mortgage insurance premium on the home value. But yeah, I definitely don't skimp on the costs when I'm testing those types of strategies.
Here's another question. It goes back to this, and I'm going to ask it, but I'd like to get your take on something beforehand. It's reverse mortgage is a risky option because most banks stopped doing them after the GFC, right? My question has to do with, in line with questions like this is, have you seen the tide shifting in terms of how people view reverse mortgages, let's say over the last 5 years, roughly when you first published your book, just simply because when you first started talking about this stuff was like kryptonite. Oh, you don't do this. This is like late night infomercial, gotcha kind of strategies. Don't do that. You were one of the first to kind of be like, well, let's do the math behind this. Right. And so I'm just curious if you've gotten, if you've seen, I wouldn't say groundswell, but have you seen a greater acceptance over the last few years as this as a viable strategy?
This is a tough one because I saw a lot of acceptance. Like if we talk about like what tracking acceptance over time, 2016 was a golden era. That's the year the first edition of my book came out. Not that there's any connection, but there were news stories all over the place, even like print editions of Time magazine talking about the value of reverse mortgages. So I thought they were gaining a lot of momentum then. Then there was a rule change in 2017. And usually there's rule changes every 4 or 5 years, but we're kind of way overdue now. 2017 was the last major rule change. And that took away a lot of momentum about the line of credit growth. Like I had done simulations in 2016 after about 20 years with a reverse mortgage. You got a 50-50 chance that the line of credit's worth more than the home. And then because it's a non-recourse loan, that would create windfall opportunities. There was a professor at MIT that called it the ruthless option. You just open up a line of credit, leave it alone, wait till it's worth more than your home, and then take it all out. And then you only 95% of the appraised value of the home is what you have to pay back. That's a lot harder to happen. It's not impossible, but it's a lot harder to happen today because of the rule changes made in 2017. And part of those rule changes were there's now that 2% mortgage insurance premium. Prior to that rule change, the closing costs could all be credited, and you could get down to, they talked about the $125 reverse mortgage. You had to pay for the counseling session, but the lender would credit everything else. They couldn't credit the counseling session by law. That $125 reverse mortgage quickly went up to the $15,000 or $20,000 reverse mortgage. And it's just been hard to get momentum after that because even though the benefits can exceed the costs, that upfront sticker shock, I think, can be a big hurdle for people. And so I think advisors have become more open and can see their value. But in terms of trends, we're not seeing more reverse mortgages today than we did 5 or 10 years ago. And if anything, it's kind of reversed because of these higher initiation costs.
I see what you did there.
But that's a question you asked. So back to Stephen's question, is the reverse mortgage a risky option because most banks stopped doing them right after the I guess the GFC means Great Financial Crisis. What is? The Grand Financial Crisis? Or the
Grand Financial Crisis?
What is the G?
My guess would be global.
Global Financial Crisis. That's better. Doesn't make it sound positive, at least. Like the Grand Financial Crisis. Well, the second part of the sentence is true. The large banks all dropped out after the Great Global Financial Crisis. That doesn't necessarily make them riskier, though. There's still a number of lenders. And we're talking about the 90% of reverse mortgages in the U.S. are the HECM program administered through the federal government, the home equity conversion mortgages. And so there's all kinds of protections in place. In fact, the reason the insurance costs are so high are because of these protections. They can't be frozen or canceled. If the lender goes out of business, you still will have access to it because it will go into the general government mortgage insurance fund. So that didn't make them a riskier option. Because really that's all there is to say. Yes, the big banks dropped out. No, that doesn't make them riskier. And over the years now, Mutual of Omaha is a big company that's now back in the reverse mortgage game. But indeed, all the Wells Fargos and Banks of America and those types of institutions, I think they just saw there's too much reputational risk.
Well, there's also this, Wade, and I was speaking to a banker and he mentioned this as well. Like even regional banks and small banks, think about the business of a bank. The bank is to lend you money so you purchase capital, right? And you know how you always, a reverse mortgage is the opposite for the bank, in which they're like, they're slowly accumulating a property, in some way, and that's not what they're in the business for, if you will. You follow what I'm getting at? Like they want to lend you money so you buy a house, not necessarily, kick money out, and then they're slowly accumulating the equity of the house.
Yeah, that makes sense. And the reputational risk, and I think that was a big factor too. When you have a reverse mortgage, you have to maintain basic homeowner obligations, basic upkeep, pay your property taxes, keep homeowners insurance. And if you don't, you could potentially be foreclosed upon. And so the story about the widow whose home was foreclosed because they had a reverse mortgage, even though at the end, if you really analyze the situation, that reverse mortgage might have given them a much more comfortable life for an extra few years before the inevitable happened, that they eventually just ran out of the ability to meet expenses. But nonetheless, the story in the newspaper is big bank foreclosed upon widow. And I think that reputational risk was a big driver of why they just, Well, your point too. It's just maybe more trouble than it's worth for them.
I don't think the banks are in the business to, over time, buy houses. They want to get that stuff off their balance sheet. They want to act like a mortgage, not the other way around. You know what I
Yeah,
mean? You
they
know how you
don't
say
want to
like
foreclose.
an annuity is like reverse life insurance? Well, you know, they don't want a reverse mortgage. They want a mortgage.
Right.
It's
Fair
like
enough.
that's what they're in the business for.
Hmm.
And that's why they're more specialty financial institutions that do the reverse mortgages. I If you borrow from the whole life, if you borrow from the whole life insurance, do you
You're
pay?
skipping one more
Oh,
reverse
did I
mortgage
skip?
one.
Okay, my bad. Let's go back again. Hi guys, long time listener, love your show. Did you write this way?
Thank you, Avid
Is your
Boater.
mom writing in again?
And this one's from Avid Boater in the YouTube comments, but
Avid
it fit
voter.
in
All
well
right.
with the discussion.
Is there any research that explores the feasibility of using a reverse mortgage as a substitute for long-term care insurance? In particular, does it make sense to set up a HECM with the intent that it will only be used for long-term care and only if no other funding sources are available? I've read Wade's book on reverse mortgages and I plan to go through it again. But what are the implications of ongoing expenses of a HECM versus ongoing expenses of long-term care insurance?
Yeah, it's a good question. And we got to put two big potential caveats on trying to use the reverse mortgage as a alternative to having long-term care insurance. The first caveat is to keep the reverse mortgage going, you have to live in the home. So it could be a great way to pay for in-home care. Most people may prefer having in-home care, like someone coming to the house on a daily basis to provide that care. But if you need to move into an institution, and if I don't know, we're talking about a single person, or like if it's a couple, as long as one person's still living in the home. But the idea is if the last person had to move out to go to a nursing home or assisted living facility, that closes the reverse mortgage. You can't borrow from it anymore. And in fact, that is creating a situation where you have a year to pay back the loan balance. So you can't treat it as a way to pay for institutional care. It'd only work as a way to pay for in-home care. The other caveat is if we're getting in the scenario where all you have left is the home, you really have to look at state laws about Medicaid also. In some states, the home may be protected so that you could qualify for Medicaid and not have to spend down the value of your home. It's a state by state basis, but just you'd want to be thinking about how do because Medicaid can also pay for long-term care if you run out of resources. So you want to understand how the home is treated as part of those Medicaid calculations in your state. And again, you want to be clear about this caveat. You can't use a reverse mortgage to live in a assisted living facility, you can't move out of the house and use the reverse mortgage to pay for that. That's all I have to say about this.
I would also think, and this is just a general break-even thing, you have to assume also that the care that you're going to need is going to be less than the amount that you could take from the equity line. That's not
right. Although eventually you may qualify for Medicaid. It's just a matter of, did you have to spend on the value of the home before you qualified for Medicaid?
All right. So next question. If you borrow from whole life insurance, do you pay that loan back later?
Yes. And actually, there's the next question. I'll just say yes for now because the next question actually we can have more discussion about that.
Why didn't you tell me to answer this question? I could have just said yes. I get my question in, and I'm done.
There you go.
Damn
yes,
you,
if you
Wade.
borrow from whole life, you have to pay the loan back later. It's not there's no such thing as free money.
Let me answer this. Yes, if you borrow from whole life, you're gonna have to pay the loan back later.
Yeah, it doesn't come from the free store, to quote Ken from an earlier question.
The free store is closed. They're selling trees. They started a nursery.
We can explain more after the next question.
All right. The hijinks is over. Let's get to the question here. If you borrow from a whole life policy, it is an interest-bearing loan, and loans have to be repaid. Question is, does it get repaid when you die and you have a lower death benefit, or do you have to pay it back while you are still alive, or risk the policy imploding, leaving you with a tax bill? I guess it all depends on when you take the loan and for how much.
Right. So let's put a caveat on the answer that make sure you understand the specific terms of your policy. But in the general sense, it could be paid back from the death benefit. It's just, what has to be carefully managed is the cash, the loan balance cannot exceed the value of the cash value while you're alive, or the death benefit if you're dead, or maybe let me say the loan balance cannot exceed the cash value in the policy. That's what blows up the policy and could make it taxable. So you want to be very careful. And if the loan balance is getting too big while you're alive, you may have to pay off some of that loan balance to make sure it's not bigger than your cash value. But that aside, generally speaking, if you pass away with a loan balance, it's just going to be paid from the death benefit, and then any remaining death benefit would go to your beneficiaries, and that doesn't create a taxable event.
Wait, just because of some listeners, some of this could sound like just gobbledygook. Cash value, what does that mean relative to a whole life policy?
So permanent life insurance, like whole life, term policies are the most simple. They just have a death benefit. And if you surrender it at any point, you don't get anything. You have that death benefit. Permanent life insurance usually has some sort of cash value because it kind of merges elements of investing with life insurance. And so the cash value is, now there may be some surrender charge, but once you pay any surrender charges, if I decide to just close the policy and stop paying the premiums, I'd get any cash value in the policy back after any surrender charges if I try to do this too soon in the process.
But a cash value is an amount that accumulates during the life of the policy. So in addition to the death benefit, you have a side account that's been grown, and you can potentially tap into it via a loan.
And most policies are calibrated so that the cash value gets up to where the death benefit is by either age 100 or 120. Otherwise, the cash value is less than the death benefit. And you can borrow against the cash value. And that's what the reverse mortgages and whole life insurance, it's a very similar conversation. With a reverse mortgage, it allows you to borrow against the home. With whole life insurance, the idea of the buffer asset is you'll borrow against the cash value.
Yeah, and it's meant, and theoretically, you can see why it's meant to be able to become more or less on par with the death benefit, because that meant the insurance company was properly adjusting the rates to get to that right level.
Mm-hmm. And then the concern in that question, if the loan balance grows to be more than the cash value, that can trigger a taxable event that you would really want to avoid. So you do have to monitor that. But just dying with a loan balance in place does not trigger a taxable event. It would just be paid back. Just again, generally speaking, there may be some exception out there. Generally speaking, if someone dies with a loan balance because they were using it as a buffer asset, say the loan balance is $200,000, but the death benefit is $1 million, the death benefit would pay the $200,000 loan balance and leave the other $800,000 going to the beneficiaries of the policy.
There it is.
Yeah. So that's buffer assets.
Oh yeah, did we get the whole? Yeah, that was the last one.
Yeah, that's the last one.
Buffer assets. There we go. All right, everyone. Thank you for this episode, listening in on this episode of Retire with Style. We'll be back next week with more mayhem and fun.
All right. Catch you next time. Thanks, everyone.